On the 15th of March, 2008, Bear Stearns, a fixture of the American financial system for 75 years, was collapsing. 6 months later to the day, on September 15th, 2008, Lehman Brothers filed for bankruptcy. Today it is tempting to see those shocking failures as the beginning of a crisis that has claimed millions of jobs, billions of dollars in retirement savings, and trillions of dollars in American wealth. But the truth is that those historic collapses weren't the beginning at all. The crisis that has led to so much economic carnage in the lives of middle-class Americans was caused by the long-standing failure of our regulatory structure to adapt to our changing financial systems and prevent the sort of dangerous risk-taking that led us here. The economic damage that resulted from those failures tears at the very fiber of our middle class. While some of the most prominent American financial institutions have been destroyed or badly weakened, the far worse damage has been done to millions of American families who did nothing wrong at all. A staggering 8.4 million jobs have been lost, and the unemployment rate remains near double digits in many areas. Nearly 7 million have lost their homes to foreclosure over the last several years. Millions more have lost their retirement funds or their small businesses in our country. Americans are frustrated and angry, as we all know. They've lost faith in our markets, and they wonder if anyone is looking out for them. Worst of all, as I stand before you today, our regulatory structure, constructed in a piecemeal fashion over many decades, remains hopelessly inadequate. There hasn't been financial reform on the scale that I'm proposing this afternoon since the 1930s. Let me be clear. We are still vulnerable to another crisis, and neither I nor anyone else can tell you with any degree of certainty that the American economy could survive another crisis of this magnitude. It is certainly time to act. Some have suggested that we should wait a little longer to take up financial reform. To them I say, how much longer do you want to leave your economy and our middle class as vulnerable as they are? How many more jobs lost, homes foreclosed, retirement savings diminished? 3 years ago this week, the Banking Committee had just finished its first set of hearings on the wave of home foreclosures. Since then, our committee has held dozens of hearings and spent thousands, literally thousands of hours on this legislation. We have listened to hundreds of perspectives from experts in a wide variety of fields. We have examined and re-examined proposals sent to us by the administration and many, many others. We've worked in a bipartisan fashion, or tried to reach as much consensus as possible. And the bill that I'll be presenting today reflects the input and ideas of my friend and colleague, Senator Shelby of Alabama, and Senator Bob Corker of Tennessee, as well as many other members of our committee, Republicans and Democrats. And so I want to begin these remarks by thanking my colleagues on the committee, all of them, for their hard work over these past many, many months. But our work must go forward. The legislation I'm offering today is comprehensive in its scope because the crisis it aims to solve is comprehensive in its scope, not to mention the tragedy of its consequences. We must restore confidence and optimism in our economy, accountability in our markets, and stability to our middle class. The point of this reform bill is not to punish the financial services industry. I know how angry people are at the mismanagement that led to this crisis. But legislating anger isn't the way to solve these problems. This legislation has three main goals. First, we must plug the gaps and eliminate the inefficiencies that allowed this crisis to happen in the first place and still exist today. Secondly, in addition to looking in the rearview mirror, we must look through the windshield. There will be shocks in our system in the future, for certain, and we need an early warning system so that the next time it occurs, our system is prepared to deal with it. And thirdly, we must protect American consumers and honest businesses so that they can and we can restore optimism in our economy and confidence in our institutions, renew the flow of credit and capital, reestablish America as a world leader in financial services, and of course to rebuild a strong foundation to create jobs and prosperity for all Americans. The bill I present today has 11 titles, many of which reflect bipartisan consensus. Let me briefly discuss the four major reforms in this bill. not all the reforms, but the major ones. First, the legislation will end too-big-to-fail bailouts. Never again should the American taxpayer be asked to write a check because of an implicit guarantee that the federal government will bail out a company when it collapses, would threaten the stability of the economy as a whole. Companies simply shouldn't be that big or that complex. It isn't safe for our nation. And we will discourage that through the new capital requirements and other strong supervisory protections. Meanwhile, when large, complex companies do fail, they will be shut down through bankruptcy or resolution in a way that doesn't threaten the rest of our economy. Senators Mark Warner of Virginia and Bob Corker of Tennessee have been invaluable in shaping this part of the bill, and I want to publicly thank both of them for their tireless effort over these last many weeks. Secondly, this legislation will create a strong and independent consumer protection watchdog. This crisis started when people were given mortgages they didn't understand and could never afford. If there was a watchdog on duty, it didn't bark. We need to strengthen not only its bark, but also its bite. I know there's been a lot of attention paid to which building this new watchdog will be housed in. That's not the important part, let me say. The important part is that the consumer protection watchdog has the independence and the authority it needs to get the job done. The watchdog in this bill will have an independent head appointed by the President of the United States and confirmed by the United States Senate. The budget for this agency will be independent to ensure that it can't be smothered by a refusal to provide it with the resources it needs. It will have autonomy to craft rules and the ability to enforce those rules. It will be there to protect consumers from the abuses that we think become almost standard operating procedures: skyrocketing credit card interest rates, the explosion of checking account fees, predatory lending by mortgage firms, and much more. Third, this legislation will create an early warning system so that someone is tasked with looking out for the next crisis, which will surely come. We will create a systemic risk council with a job of scanning the economic radar to identify unsafe products or practices that could threaten our economic stability, and the authority to stop them when they occur. We were caught off guard by the subprime lending crisis. We cannot ever allow that to happen again. And fourth, this legislation will bring transparency and accountability to exotic instruments like hedge funds and derivatives that have for far too long lurked in the shadows of our economy. These activities left investors open to tremendous risks they didn't even know existed. Billions of dollars were traded, or perhaps the better word is gambled, behind closed doors. This too must stop. Now, the discussion draft that I introduced in November contains very strong measures to bring transparency and accountability to these sectors of our financial system. And the legislation I present today includes similar strong language with some changes. Senators Jack Reed of Rhode Island and Judd Gregg of New Hampshire, like Senators Corker and Warner, have done tremendous work over the past number of months, and they're continuing their work on this section of the bill as they try to reach consensus. It'll be incorporated, if they are able to do so, in the legislation when it's ready. Meanwhile, we will rein in the insane compensation packages that have outraged the public and hurt our financial system by rewarding short-term profiteering and wild risk-taking. I want to commend Senator Chuck Schumer of New York for his terrific efforts in crafting these reforms that are included in this proposal. There's more in this bill. For instance, it creates a new program at the SEC to encourage whistleblowers. The bill imposes more accountability on credit rating agencies. The bill cracks down on conflicts of interest at the Federal Reserve, making the head of the New York Fed, for example, a position appointed by the President of the United States and not handpicked by the very bankers the New York Fed is responsible for regulating. Our goal in the legislation is to end business as usual and create a system where honest businesses, large and small in our nation, can thrive on a level playing field, where middle-class families can find work and invest with confidence. The legislation I present today contains bipartisan ideas and is the result, as I mentioned earlier, of a bipartisan effort. It does not, as of yet, of course, enjoy bipartisan support. But we do need to act, and I will act. Every day we delay is a day we are unprepared for what's around the corner. A day when Americans who have lost so much continue to lose confidence in our economic system. A day when we are refusing to confront these very real threats to our economic way of life. And so while I continue to work with my colleagues to build support and make a case for these reforms, I am moving forward today. The stakes are far too high, and the American people have suffered far too greatly for us to fail in this effort. This legislation will not stop the next crisis from coming. No legislation can, of course. But by creating a 21st century regulatory structure for our 21st century economy, we can equip coming generations with the tools to deal with that crisis and to avoid the kind of suffering we have seen in this country over the past number of years. So let me conclude on this note. We will have financial reform adopted this year in the Congress of the United States. And I'll be happy to take your questions.
Senator, with this bill, do you think that abundant bank tax is actually necessary since this could limit?
I don't have it in this bill.
And so do you...
Well, it could be. That's one that will be considered, but not in this legislation.
Senator, only the summaries are available online, and I'm just wondering when the full legislation will be available. And
Well, it should be now. I think it's gone up. Has it gone up? I'm looking at staff.
Any minute.
Senator,
Any minute.
The banks are going to say this is too much government restricting us and reining in risk, and it's going to make them less competitive with competitors overseas. How would you respond to that?
Well, that's been their complaint. But let me just say, this has been over the last several years. We've learned, obviously, the kind of condition we're in because either we didn't have regulation or the regulators that we had weren't doing their job. This bill is designed to do both. One is to plug in the gaps where regulation didn't exist, and secondly, to see to it that those who are accountable for these responsibilities will do so. Part of the problems has been, one of the things we do in this bill is, of course, to provide clarity in the regulatory structure. So there are clear lines of authority. What is the Fed responsible for? What is the OCC responsible for? What is the FDIC responsible for? So there is that clarity. Too often in the past, we had a variety of agencies that could claim some jurisdiction over various pieces of this. So the consolidation, it isn't as much as I offered in November, where I had one single prudential regulator. That's changed, obviously, in this proposal. But it does provide consolidation and a lot more clarity, which I think is an asset for our lending institutions. Should not be seen as a burden, but rather clarity and accountability, which I hope they will receive.
Senator,
the consumer agency, as you touched on,
Yeah.
How will that distinguish between small entities such as credit unions and larger ones in terms of whether they will still be regulated on consumer issues by their safety and soundness regulator? How will that deal with that?
Well, first of all, we exclude institutions under $10 billion. The rules would apply, but obviously we're not going to be regulating small entities, mom and pops, not the butcher, not the dry cleaners and so forth that some have suggested with all of this. But clearly we not only want to be able to deal with the mortgages and the brokers and servicers that were at the root of so much of the problems we're facing, but also to get into the non-banks, the larger entities as well, particularly. And we're talking about large entities where these problems occur, and payday lenders and other operators that are big. That's how it's going to work. Now, if you get into, and people have talked about this, safety and soundness, I don't see these kind of conflicts that people are threatening as being large and luminous. But if there is, there's an ability in this legislation to resolve those conflicts. But the idea somehow, we were told that our institutions were safe and sound, and yet what happened, the root cause of our economic crisis was the lack of consumer protection. We all know that today, in fact. It were those subprime mortgages without proper underwriting standards, all the things that various consumer protection divisions within various prudential regulators were supposed to be watching out for and didn't. This bill, as I said, provides that independence by meeting the four principles I outlined some time ago. Appointed by the President of the United States, confirmed by the Senate, a separate funding authority, and the ability autonomously to write rules and to enforce those rules. This bill does all of those things.
Senator, you've been very critical of the Federal Reserve. This bill would seem to increase their power and their authority in the economy. How do you...
Well, again, I know there were those, this notion of being punitive or and so forth, the Fed. As I said in the statement here, legislating in anger doesn't seem to me to get you very far. What makes sense? What's responsible? As you recall, we had a debate that went back and forth, and certainly I raised issues about the Fed going back to its core functions. The Fed, of course, and those who felt differently made the case that having supervisory function over our largest, more complex institutions was necessary for them in order to perform their monetary functions. I felt sort of agnostic about that idea, is convinced that that probably made some sense. So initially we had a single prudential regulator, and that changed, obviously, when you had the issue of dual banking be raised and the like, so we began to break that down. And it seemed to be, once we began to move in that direction, that arriving at where we did in this bill made more sense. And therefore, I feel as though we've got a good system in place for those institutions, those bank holding companies that have assets in excess of $50 billion, these large, complex institutions. They will have that jurisdiction over those. They also have their other functions that they will perform. For foreign banks with subsidiaries in the United States, they'll have jurisdiction over that as well. So I don't necessarily see it as punishing the Fed, but rather getting back to core functions and having clear lines of authority.
Senator,
Yes, sir.
Senator, you've been trying for months to get Republican support. So far, you haven't even gotten one vote. What gives you any confidence that you'll be able to...
Well, I mentioned in this bill, and I say this to you, and again, there are 11 titles to this bill. And let me just say that I would say on 9 of these titles of the bill, there is agreement or substantial agreement. There are some technical issues I'm sure we'll be debating. 2 of the titles, in the consumer protection area and in the corporate governance area, there's also some agreement, not completely so. I heard Senator Shelby say this morning that we're about 85 or 90% there. That may be a higher number than I would suggest at this moment, but we're well along the path. And so while I don't have standing with me today bipartisan support at this podium, this is the time I'm now introducing this bill. We'll begin the markup next week and move forward. For those of you who've covered the legislative process over the years, you know that at any stage of the development of a bill, you can develop that consensus. Ideally, in some cases, it happens before you write a bill. Sometimes it happens when you actually do write the bill. Sometimes you have to wait for the markup of the bill for it to occur. Sometimes not until you get to the floor of the United States Senate. And even sometimes further when you get to a conference committee. This is the first stage of that process. And again, I can't emphasize enough, it's not just platitudes. I'm not just trying to compliment colleagues. This product that you'll be looking at today reflects an awful lot of work that has gone on between Democrats and Republicans on this committee. And it is not, I don't say lightly when I express my gratitude to Senator Shelby, Senator Corker, and again the other senators I've mentioned, Senator Reid, Senator Judd Gregg, as well as Senator Warner, who have worked so hard to get us to this point. So I am optimistic about getting that consensus because of the path we're following.
Senator,
Yes,
are you
sir.
concerned that the possibility of a partisan rancor over reconciliation in health care will affect the chances for a bipartisan bill?
Well, there's always that possibility, but I hope not. Again, these are separate matters. And again, I don't happen to believe that I'm the only guy or my party's the only party in town that cares about these issues. I've heard Senator Dick Shelby talk about consumer protection. Now, we differ on how best to do it. I believe what's going on in the country, the level of unemployment, the loss of homes, the loss of retirement, the loss of health care, the loss of small businesses, all across this nation. This wasn't just about the collapse of financial institutions. We've been focused on that. But there's a job at a small business in rural America that's been suffered or lost because of what's happened in our economy. And I believe all of us have an interest in getting back on our feet again. So I'm, again, confident that on this subject matter, there is a broad consensus that we need to reform the financial system, we need to protect consumers, we need to provide more accountability, more transparency in our lending institutions, in our financial institutions, and I believe we can get there.
Hotel California provision and investment banks, I presume that means Goldman and Morgan can't back out of their bank holding status. They'll forever now be treated under Fed supervision.
That's correct, and I attribute that Hotel California. I know there's a song that the authors deserve credit for it, but Bob Corker deserves credit for including it in the language of this bill.
Can you talk about the Volcker rule? You seem to have a firmer prohibition against proprietary trading than seemed possible a couple of weeks ago.
Well, again, and this is and I support the idea that we need to have some real restrictions on proprietary trading and related activities that occur. But again, I've always felt, those of you who followed the committee over the years, that the banking committee, or Congress for that matter, is not good at writing regulations. And our job here is to set guidelines, which we have regarding the so-called Volcker rule, and then we're charging those responsible for doing so, not if they would report back, but they must report back on how they would accomplish that. And we've laid out some clear guidelines in the bill without specifying exactly what the rules ought to say, the regulations ought to say.
So the regulations don't have to say a prohibition?
Well, they would in my view on certain activities, without any question. But how to do that, I think, is a far more sophisticated, requires a more sophisticated answer than you can provide in a piece of legislation. That's why we're delegating that with a clear authority and accountability to come back with rules in that area.
Do you intend to include auto lenders in the consumer protection agency?
We've left out specific areas like this because I don't want to be in the business here of carving out. We're talking about large financial providers, and certainly that could fall into one of them. But I'm staying away from trying to write what in and what's right out. We're trying to allow the agency itself to make some determination so we don't get in the business of picking winners and losers based on political clout, it seems to me. So I've stayed away from that in the bill. Yes.
Sir, it would seem that the Fed in this summary is given the power to determine the budget for the consumer protection.
No, they're not. No, they're not. Absolutely not. The budget will come from the Fed, but they don't determine that. That'll be determined by statute or other means. The Fed has absolutely, I don't know how I can say this more firmly to you. The fact that this institution would be housed, rented space in the Fed, does not mean it has one iota of authority over the operation, the budget of this agency or this bureau or division.
Can you address more broadly the concern you'll hear from some consumer advocates who say it doesn't belong in the Fed because they fell down on the job in the past?
Well, again, I've heard some. Actually, they've done a better job in the last couple of years under Ben Bernanke than was the case earlier. But certainly the earlier criticism was well-deserved. The problem is, in meeting the four principles, where can I achieve that independence? How best do you do it? I believe the independence of it, as we identified in the bill, the presidential appointment, the confirmation by the Senate, the independent budget authority, the rulemaking authority, and the involvement in the examination and enforcement are very clearly laid out in this bill. That's what I've been determined to do from the outset. We do it in this
Why not an
construct.
independent agency?
Well, again, I think you know the answer to the problem in terms of votes on that one.
Senator, can you
Yeah.
explain the appeals process on consumer regulations? Who would make that determination? How will it work?
Well, the presumption is the regulation goes forward. Now, there have been those who've argued that you could run into some conflict here with consumer protection regulations and safety and soundness. And I've yet to have anyone identify what they mean by that, but nonetheless, we provide here, if in fact there is such an issue raised, that we then, utilizing the Systemic Risk Council, which we have in place, could make a determination as to whether or not there's any validity to that claim. But the presumption would be that the regulation from the Consumer Protection Agency would go forward.
Is there a voting threshold on the part of the council?
It would be a two-thirds vote. It would require two-thirds to overturn it. Let me just see if someone else gets anything. Yes.
Will you have a chance to speak to Senator Shelby since you put this bill together, and do you think you can reach a deal with him before markup, delay markup in order to reach?
Well, Richard and I talk all the time. As you know, we have a very close personal relationship. We're good friends, and so we talk not on necessarily on a daily basis, but I'll stay in close touch with him. Our staffs do as well, and he knows that door is open. Again, I thought his statement last week was a very positive one, and I thought his statements today were, again, very positive on how he identified that we were there. And his point about not letting politics get in the middle of all of this, I couldn't agree more. The job is too important, and compromise is important, not on principles and not moving away from what needs to be done to provide the kind of assurances and confidence that people need in our financial system. And so if we can stay on that track, as we have in Titles 1 and 2 of this bill, for instance, on the resolution mechanism and the too big to fail provisions here of the Systemic Risk Council that Senator Warner, Senator Corker have worked on, and where we have agreement, where I think we can get agreement on the derivatives section that Judge Gregg and Jack Reed have worked on as well, where Chuck Schumer has worked on, and corporate governance issues, and we've achieved a lot of closure in those areas. Those are all areas where basically we have what I perceive to be consensus on the bill. So there are other pieces we do not. So I'm still optimistic we can get the final consensus on the bill.
Senator.
Yes, I can go, Victoria.
Do you expect to have all of your Democratic colleagues on the Banking Committee support this?
Well, I've talked to all of, I think all of, I missed one or two over the weekend, and talking to them about where we were and soliciting their thoughts and ideas. And my hope is, again, that they'll be supportive of this. That's not to say that every one of them will agree with every aspect. This is a large, complex piece of legislation as it's proposed. But I've tried to listen to my colleagues. 1/4 of the United States Senate sits on the Banking Committee, 22 other members. And so I've got to be sensitive to their interests and concerns. This is not a decision where one person can make a determination without consultation of his colleagues. Let me add to all of you as well, and I mentioned time, and I know again this notion of delay and waiting a while. By my calculation, and some of you may have a different number, we have about 60 to 70 days, legislative days left in this Congress. If you exclude the periods of recesses coming up, the August break and the like, the assumption will probably adjourn around the 1st of October for the elections. We don't have many days left to actually get a job done. So there is a sense of urgency. Now, we've spent an awful lot of time over these last 2 years, and we have not exhausted the subject matter. I'll be the first to admit that. But you could go on for years and never exhaust the subject matter included in this proposal. But we do need to act. It's time now to make decisions, yes or no. Are we going to go forward? Are we going to do the things I've outlined here and suggested in this bill? I believe if the will exists, and I believe it does at this juncture, to get to yes, that we can get this bill adopted. I thank you all very much.